The 2024 Stansberry Research Conference and Alliance meeting is back this fall in Las Vegas. And for the first time ever, they've extended their early bird discounted ticket pricing, which means if you reserve your seat today, you can save $450 off your ticket. Head over to www.vegasearlybird.com to find all the details and get your discounted ticket. The Stansberry Conference is truly one of the best business mixed with pleasure industry events out there. Past speakers have included Shark Tank's Kevin O'Leary, Dennis Miller, and Steve Forbes. And of course, all your favorite Stansberry editors will be there too, including yours truly. I mean, I hope I'm one of your favorites. I look forward to this event every year. It's great getting the chance to meet our listeners from the show, whether it's chatting during a break or grabbing a beer at the end of the day or whatever. So I hope you're planning to join us. It's a great event. Go to www.vegasearlybird.com to get your discounted ticket before prices increase. That's www.vegasearlybird.com. So come on out and find me in Vegas and say hello. David Trainer, welcome to the show. Good to have you.
Thanks for having me, Dan. I'm glad to be here.
Yeah. So you're a new guest on the show, and I'd like to sort of ask my stock first question for new guests because it seems to work. So if you and I were just, we met in a bar or something and we got to talking and finance came up, and I said, oh, well, what kind of investor are you? What would you like to, how would you like to answer that? What would you like to tell our listeners about that question?
I call myself a modern value investor, right? I think the old school value investors were known for kind of trudging around and shuffling a lot of papers and going through a lot of data. We bring AI to value investing. So we're taking it to a new level by really using technology to sort through millions and millions of financial filings and data points to produce materially superior measures of profitability and valuation that takes traditional value investing to the next level. And what that means is that you understand where value is and you actually move a little more dynamically than the legacy guys who kind of, the old school value guys are like, oh, you own something forever. That doesn't really work anymore.
Oh, owning forever doesn't work anymore. Okay. So that's an interesting statement to me because I feel like, that was like the second era. The first era of value investing was cigar butts, right? And the second era was finding great businesses and owning them for a long time and compounding. But you sound like you're the modern guy. You're the third era guy. So can you get into that a little more deeply? If owning forever doesn't work anymore, then you got to know that really hard thing that so many people don't know, which is when to sell.
Right.
That's what intrigues me about that.
Yeah, no, I think that's one of the modern facts of today's trading is that like stocks can go from cheap to really expensive in less than a lifetime, right? So you don't own them forever. There are points in time where they get too expensive. Nvidia's a great example, right? They flew too close to the sun and the wings melted, and so it's become an overvalued stock, even though the underlying economics of that business are very strong, right? And so there are stocks that you want to sell in a lot less than a lifetime, so you don't own them forever. There's still those compounders out there. We've got some stocks on our focus list that have been on there for years, and they continue to do really, really well. But if a stock skyrockets up 2,000 or 3,000% in the space of 6 months or a year, it's only smart to start to take some gains, take some capital off the table, reallocate that back to stocks that remain cheap and still have good fundamentals. And that's the idea, is that we've seen markets move fast. We've seen them turn on a dime, especially with some of our zombie stocks, right? I mean, one of our, we had a couple zombie stocks go to zero. One of our danger zone stocks, Express, just filed for bankruptcy today. We've been warning about it for years. I think not too long ago it was two or $300. Now it's about to go to zero. So these things happen fast, real fast.
Right. Yeah.
And as a modern investor, you got to be able to move a little more quickly. You can't just buy and forget like the old days.
All right. Um, Now, the use of AI to do some of the analytical work or data collection or however you use it, that's really interesting to me too. Um, I want to say how do you do it or what do you do because it's just such a AI is this enormous topic that encompasses all kinds of things. But maybe you could tell us like the one or two most important things that you get out of using artificial intelligence to scan documents.
Yeah, I mean, Dan, I could talk about this topic forever, and we're happy to talk about
I
it
know. Yeah.
because because people are like, oh, don't give up anything, David. I'm like, no, no, no. It's like Tom Brady can show you how to throw a touchdown pass. That doesn't mean you're going to be able to step on a football field and do it, right?
No. Yeah.
So AI is a very misunderstood topic. I've been writing about it for decades. I've been doing it for 25 years before the terms machine learning and AI were even out there, right? And what people don't realize is that the core of AI is not sexy. The large language models and chatbots and stuff that sit on top of things, those
Hmm.
are great technologies, but they're only as good as the data that goes into them,
Right.
right? This is why ChatGPT hallucinates, because guess what? Not everything on the internet is true, right?
That's
What would
great.
you say, Dan? What percentage of the internet is true? What percentage of the data that goes into ChatGPT can we trust?
I mean, one,
Yeah, exactly.
really, honestly. I mean, I've asked it all kinds of questions and gotten all kinds of absolute baloney. I mean, just baloney. So yeah, not much. It's a low
Yeah,
percentage.
yeah. And so think about the AI and the technology is the engine, the model is the engine, data is
Hmm.
the fuel,
Right.
right? AI is a great technology, but if you're pouring low grade gasoline into it, you're not going to do very well, right?
Right.
And so what New Construct started with was creating a better fuel because I knew the technology was always there. Look, from the beginning, even the old school value investor guys, they would tell you your model is only as good as the inputs, right?
Mm.
If your model for measuring whether or not something
Yeah.
with a cigar butt was based on bad data, you're making a
Yeah.
bad decision.
Well, this goes back to like the 70s, like the oldest computing stories in existence, garbage in, garbage out, right? Gigo. So absolutely, it's the point is well taken.
Exactly. Garbage in, garbage out. So what we created was a better data set. And we have proof now that our data is superior from a paper published by the Journal of Financial Economics, one of the top peer reviewed journals in the world, and a paper written by professors from Harvard Business School and MIT Sloan School of Business, School of Management,
Hmm.
that proves our data is better. And that's really what I started with because I was on Wall Street, right? And before the tech bubble. And that was back when they were sort of the 1.0 and 2.0 sort of value investors, Dan. They were like, they go through the filings, they'd read it, and build models. And then when the tech bubble came, they threw all that out the window. And I know because I was advocating for that. I ran a special business within Credit Suisse that was like, hey, we're building a better model because if you pay executives based on accounting earnings, you can pay them to run the business into the ground.
Yeah.
We got plenty of high profile stories going back all the way to WorldCom, Enrod. They were great earnings, business run into the ground. Valiant, Express.
Hmm.
We're seeing this in more modern terms. Tesla is going to be another one of those. And so um, uh, people were no longer doing the work to get the good data because it didn't pay. There was too much money to be made in getting that IPO out the door. We all know how that ended with the tech bubble, with those analysts being busted for, hey, this is such a great IPO, everyone should buy it. And then to my friends, oh, I can't believe everybody's stupid enough to invest in this piece of blank. Right? They caught them red-handed on that.
Yep.
So I knew that there were not only were people not doing that anymore, people didn't want to do it, and the number of people in the world that were able to actually read footnotes and build a model was quickly going to like zero
Yeah.
because the people that had the education, experience, and expertise to do it were getting paid too much to do other things. So that's where I got the idea
I
that
see.
we needed machines to go through these filings because you just couldn't find people smart enough uh, and willing enough to do it for extended periods of time. So
Okay.
it took, it's a very, very sort of detailed, painstaking process to kind of carefully mark up these filings and
Hmm.
teach machines to do things over time. And it's one of those things that it builds over time. Once you've taught a machine that, hey, this is the revenue number and this is the gross margin number, you do that 10,000 times, and the machine doesn't need a human to do it anymore. That's a bit of an oversimplification, but we've
Sure.
done that millions of times over 20 years so that now we have this really robust training data set that feeds an AI technology. And I
I
would I
see.
would submit, Dan, that we're the only real AI that works. Right? ChatGPT is great, but it doesn't
Hmm.
work because you can't trust it.
Right. Okay. And because you've got whatever it is, a couple of decades or 25 years of learning and data behind what you're doing too. That's fairly significant and probably not especially easy to replicate, I would guess.
Bingo. I think the
Yeah.
moat's pretty wide. I really
Yeah.
do. I think you're right. And look, we've got a big lead on the market because not only is our data superior, but with superior data, our AI can produce superior financial analytics. That's
Hmm.
proven by a paper from Ernst and Young, and then we produce superior stock ratings, proven by a paper from Harvard Business School. So we've got a pretty wide moat, high barriers to entry for sure. And yeah, I think it's going to be difficult to replicate, Dan, because there's just not many people who want to do it. How many people do
Okay.
you know that actually like to read footnotes?
Yeah. Not many. Um, I don't even know if I really like it, although it's something that I stick with because every now and then you find a really juicy one. But uh, it's funny right now, rather than asking you about what the machines are doing, all of a sudden I want to know what the people are doing. So if the machines are scrubbing through data, and as a value investor, of course, the standard posture is for me to sit here going through 10Ks and 10Qs and reading them and figuring out what's in them and producing my own spreadsheets and all of that. Sounds like a lot of that is automated. So what are the people doing
The people
in
at New
your firm?
Constructs,
People in new construct. If the machines are doing all of this work, what are the people doing?
the machines do about 95 to 90, 95 to 100%. They don't get it always right. Right. And so
Hmm.
what we are doing in the process over the years, Dan, has been, in the beginning, the humans they marked everything up. Right. Now the machines
Right.
can mark up a lot on their own, but the machines aren't sure of certain things. And so we
Hmm.
continuously have the machine only allow itself to parse things that it's 100% sure of. And then we can typically validate in a number of different ways. And then when stuff comes along that's not 100% sure, well, humans come in and say, okay, this is the right answer. And here's why. So we're constantly building on that training data set over increasingly complex areas of filings. Number one, we do that. Number two, filings are changing. The accounting rule setters are changing the rules all the time. I mean, one of the great tricks of the last couple of years is
Hmm.
is the whole off balance sheet debt thing, right?
Oh yeah.
The accountant said, "Oh, hey, we're bringing all the off balance sheet debt on balance sheet. Thank you. We're doing everybody a service." And then what does corporate America do?
Yeah.
Create new ways to keep the debt
To
off
get it
balance
off.
sheet.
Yeah, that's right.
And so we have to build our models to collect these new data points, right? Before there weren't these variable lease payments.
Hmm.
There weren't these sort of prepaid lease payment type things that are now significant amounts, billions and billions of off balance sheet debt hidden in new vehicles, effectively. Right. And so we have to go in, see how the disclosure actually manifests in the filings, build a collection system to get the data, build the models to calculate the data correctly. Right. And then
Hmm.
fix the accounting. So there's stuff like that that's going on constantly. And then we're always, building on the product. Several years ago we added ETFs to coverage. We added mutual funds to coverage. A few years ago we added credit ratings. So now we analyze debt. and credits as well.
This question is inspired by a story that I've told a few times on the show when we talked with mostly with traders, like futures traders and stuff. When sometimes we have market wizards types on the show, and I just remember I visited one of those firms once, and of course they've got a whole system for spitting out trades and establishing breakouts and whatever they're trading. And it was at the one firm I visited, it was a fireable offense not to trade the signal. They have like all these PhD computer scientists and mathematicians and physicists and stuff on one floor, and then the traders on another, and the traders have to trade the signals. And I was left alone with the trader for about 5 minutes, and he said, "See, we just got a signal here." And then he looked at it and he said, "But do you really want to trade after 3 hours of this? I don't think so." And I was like, "Oh, okay. I hope you don't get fired." The point being, like, does your system ever generate, trades or recommendations or ratings that you look at and just go, "No way, no way"?
I don't know about. I mean, I think shorting. We get a lot of like say stocks that should be shorted, and I think we ran a hedge fund from 2006 to 2016. We
Mm-hmm.
launched in 2008, and one of the things I learned during that time was you could have the best short in the world, and it could blow up in your face.
Yeah.
I'll never forget there was an oil and gas conglomerate losing tons of money, terribly overvalued, and we put a nice short position on there. And then they announced that they had hired Bank of America to evaluate their strategic options, which anybody from Wall Street knows. Please find someone to buy us before we go bankrupt. Well, the stock
Right.
goes up 40%. We get
Yep.
knocked out of our short. And then, of course, 4 or 5 months later, it goes bankrupt. Um, so I think that's part of being a modern value investor is like, listen, the fundamental signals can be so true, but as Warren Buffett says, hey, the market can be wrong for longer than I can be solvent, right? And
Right.
so I think, yeah, there are fundamental signals that may very well be true, but the market's not going to pay attention for a while. And so you got to sort of got to be a modern value investor, and I think it's
Yeah.
awesome to pair what we do with technicals, make sure
Right.
your
But
entries.
David, it sounds like the answer to my question is like, no, you really have a lot of trust in your system, because what you're telling me, it happens after that. So like what the market does, yeah, no, nobody controls that. There's no AI that controls that, right? That's what you're telling me. But it sounds like the real answer to the question is no, our system spits out really good ideas consistently.
Yeah, I mean, Dan, I mean, look, I'm not going to say our analysts have never made any mistakes. We made a
Sure.
lot of mistakes over 20
Right.
years, but we've also got it on an automated system that every time we make a mistake, we create what we call a data check, and
Hmm.
the system forever checks to make sure that kind of mistake is never replicated. And so that's a
Wow.
process we've been applying for 20 years. But my answer to your question, candidly, is I believe in the fundamentals of what we do,
Right.
and I don't believe anyone else can match it. That said, fundamentals are not always what you want to trade, long or short. But our
Right.
fundamental analysis is
Mhm.
by far, I believe, the best in the world, and no one can match it. I mean, there's never been another research firm that has had papers from the Journal of Financial Economics, Harvard Business School, MIT Sloan, Ernst and Young published proving the superiority of their data, models, and ratings. Never happened. And we've got a stock picking track record on Sum Zero, which is professionals,
Mhm.
right? We've been ranked number one across 5 to 10 categories for 36 months in a row.
Oh,
So, however you want to slice it, no one's done what we've done. We're breaking records, I think. We're breaking a new mold with this
right.
modern value investing technology. And we think it's going to revolutionize markets. And yes, absolutely trust it and believe in it because we've got proof that it works.
Wow. Okay. So just to be clear, though, it sounds like New Constructs does not. Am I correct? You do not manage money. You do not have other people's capital that you're allocating, or
We
you
do
do.
not. We do
You do
not.
not. Okay.
We do not. No. New
Just
Construct has never done that. Now, we had some separate entities that were affiliated with New Construct. They were subscribers to New Construct's data, but those closed down 8 years ago.
mhm.
Um, We do have a relationship with Bloomberg where we're planning to launch passive ETFs.
Hmm.
And that should be happening. That should be announcing something about along those lines in the next few weeks with a top 5 issuer. But that's just the data feed that they use. They're more like a client. Like we have
I
some of the
see.
top quant funds in the world that take our data and use it to manage money. Bloomberg takes our data, use it to create ETFs. We're going to launch an ETF with a top 5 issuer. So there are definitely money management applications, whether it's our clients or whether it's some of our partners, for sure. But I do not. We do not have a hedge fund, so we're 100% independent, Dan. That's a big deal for us. We've always been
Mhm.
independent. We don't have bias. We're not using our clients against themselves. You know what I mean?
Oh, I do
Right? We're
know what
not
you mean.
Wall Street.
Yeah. Yeah, that's, I mean, that's part of Stansberry's claim to fame, if you will. We're completely independent and we don't take advertising and all kinds of other ways to describe it. We don't manage money. We don't take advertising. We're completely independent. So, if we don't, it's just we're in the same boat here. If you don't do the work that your clients need you to do, if it doesn't work, you're through. So, just the fact that you're still here and the fact that we're still here suggests we're both doing something right, I think. Uh, well, this is fascinating to me, but I have to tell you, as a long time sort of value oriented, fundamental, bottom up investor, um, it's a little troubling because, I mean, there's new construct out there. I'm like, wow, is new construct going to put me out of business? Because you um, what you're doing sounds like it's so superior to anything like any individual or even group of humans can do. Um, and it
Dan,
makes me,
I mean that's like the same people that were in the business of carrying around rocks felt that about the wheel,
yep,
right? And look, you're successful and you're smart because you know how to use tools, and humans over time have just been better at using tools. New
mm,
constructs is a tool; it's not going to replace everybody.
right,
Um, that said, you're not the only one that feels that way. Look, since I started marketing this
yeah,
product to institutional investors, shoot, back in 2005 and six, there's a Harvard Business School case study that quotes me in some of my meetings with institutional investors who said, David, your data is probably better, but as long as everyone else is using the same bad data, I'm okay with that. Or they would say things like, yeah, you're taking away my competitive advantage. And my answer is, no, I'm giving you a new competitive advantage.
right,
Take advantage of what we provide to more precisely understand fundamentals and use that to augment the rest of your strategy. Because
right.
honestly, I don't, for one, believe that investing should be 100% fundamentals based only.
Oh, so I thought you did mention a few minutes ago. Correct me if I'm wrong. You started to mention technicals, and I think I cut you off. Um, do you want to talk a little bit about that?
Yeah, my point being that, look, it's a big, complicated world. And if you're fundamentals only, you're going to get your face ripped off. Like I got my face ripped off on that short when we were in a hedge fund,
Hmm.
right? And those kinds of things happen if you're 100% fundamentals. And I don't think people should be 100% fundamentals, but I also don't believe they should not be 0% fundamentals. And if you're going to rely on fundamentals at all, well, you better damn well be sure that you're relying on the true fundamentals. Because if your fundamentals are giving you the wrong signal, then
Right.
everything thereafter is wrong. Option strategies, technical strategies, sentiment
Yeah.
strategies, all of those things. If you can get all these things to align, well, then you got a superpower. And so yeah, I think we take that into account. We also look at strategic analysis when we're writing up our long ideas. And we've got a small research team as well, and we do research where we will write up like a traditional sell side analyst report, on
Sure.
particular stocks and explain here's why. Those reports are like mini case studies on how to use new constructs, which is I think really cool. But a big part of investing at the end of the day is, do I agree or disagree with the expectations for future cash flows reflected in the stock price? And that's what all of our models are effectively positioning our clients to do. And that's a question that's not just about the numbers. That's competitive position. That's how markets are changing. that's technicals, that's a macro environment. And I don't believe that investment decision making should be made in any kind of vacuum for any one of those silos. Ultimately, you
Hmm.
want to bring all of those to the table, but you need really high quality product in each one of those in order to have a trustworthy investment decision process.
Yeah, I smiled when you talked about the expectations for cash flows being, whether or not they're baked into the current price. That is exactly what my partner, analyst Mike Barrett, and I have been doing in our Extreme Value newsletter for the better part of about 14 years or so here. Um, I read a book called Expectations Investing by Alfred Rappaport and Michael Mauboussin. And I just sent it to Mike and said, maybe we should do something like this. And he built the model and we're doing it. And that was it. And it works very well, I have to say. You know, Bill,
100%. We are
yeah,
expectations investing applied, right?
yep,
So Michael Mauboussin and Al Rappaport, I worked with those guys when I was on Wall Street. Mauboussin was my mentor. I remember helping um, edit Al Rappaport's, I think, the second version of creating shareholder value.
oh,
But we brought the reverse DCF model to Wall Street. I did it when I was at Credit Suisse. And New Constructs is the application of that. We do that at scale, and we give our clients the ability to 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 play with these models. You can put in whatever inputs you want, And for example, when we put Nvidia on our buy list, the stock price implied that its profits were going to permanently decline by 50%. We're like, oh, that's cheap. Well, right now, Nvidia's stock price implies that its profits are going to be greater than the GDP of Ireland,
yeah,
right? And about
right,
20 times where Apple's profits are today.
yeah,
Right. So expectations, right, when you quantify them in this discrete way, I think it's a game changer. It's like, wait a
yep,
second. I'm not talking about whether I believe AI. Let's just talk about this stock. All right. The expectations are for cash flows to grow at 30% compounded annually for 30 years to some unbelievably large amount.
yep,
Well, then maybe I need to put the pause button on the buy here. Maybe they take some gains and go
yeah.
find another reasonably profitable company at a much better valuation. We found a bunch of those for our clients. Some AI stocks that people haven't discovered that have been cheap, that were cheap, and have had a lot more room to run.
Yeah, what really, one of the many things that sort of impressed me about the expectations approach is that oftentimes you look at the old school traditional sort of Graham and Dodd fundamentals, the things like price to book and price to earnings and price to free cash flow and all that stuff. And they can look unattractive, but then if you do the, you know, expectations modeling correctly, that same stock that looks unattractive by those old school fundamentals can look like a real bargain. And we've done that numerous times, like in the the post 2008 era of zero interest rates. Um, Without that, we'd have been sunk. I'd have been out of business because nothing would have looked cheap by the old ways.
1,000%. Ratios are shortcuts,
Right.
and shortcuts can
Yeah.
get you into trouble. Any
Yep.
ratio is a shortcut. And yeah, that's part of our AI is to build a better fundamental data set, because whatever your discounted cash flow model or projection mechanism is, whatever you want to call it, if it's not based on the best fundamentals, then whatever you extrapolate could end up being wildly off the mark, right?
Hmm.
So that's part of our AI is a reverse DCF modeling capability that quantifies the expectations baked in the stock price. And
Yeah.
we have the market implied competitive advantage period. We've been doing that. I've been doing that for 25 years.
Yeah. So, I mean, in extreme cases, like when you see something trading 60, 100, 200 times earnings, you're not surprised when the model says, yeah, this thing is discounting the GDP of Ireland or whatever. Um, but, but overall, though, I'm just really gobsmacked at how many times that has not been true. And it really is a whole different, much more effective way of reading fundamentals. And it warms my heart, David, that like the guy who's doing all this AI stuff is has expectations investing at the core of it. Of course, that's why people are writing papers and you're getting, setting records. That makes perfect sense to me. Thank goodness something about AI makes perfect sense to me.
Well, thank you, Dan. And it should, right? I mean, reasonable people can disagree about a lot of things, but
Yeah.
the right way to do things for fundamentals, it's hard to
Yep.
disagree with. You need to
Yeah.
do
I
the
mean,
diligence.
look, that's right. We know what things are worth. They're worth those cash flows discounted back to the present, but you can't predict them, right? That's why, as you said, it's a reverse DCF that helps you get to the right value.
Yeah, I love telling all my new analysts. Would you rather be a fortune teller or a critic of a fortune teller?
Exactly. That's well. But I'm going to steal that. I like
You're
that.
welcome to. You're welcome
Yeah,
to.
I'm going to steal that for sure.
And so, yeah,
Um,
Mr. Market's in the job of predicting fortunes every day for every single stock price. So let's just
yep.
figure out what kind of fortune he's predicting, and that's what we
Yeah.
do at scale.
All right. So, excuse me. Um, so we've talked about what people do and what the machines do, um, and sort of what your business is about. Um, I wonder if we do like to teach our listeners how to fish. We also like to give them a fish every now and then if we can, even if it's just like a sector or a general idea or just the way you're looking at the market right now. What do you see? What does the new construct system sort of tell you about what's going on in the world and what's attractive and what's not right now?
I just did a webinar on this: two hottest sectors and two like most dangerous sectors,
Okay.
and we talked about we like energy. And by the way,
Hmm.
we have sector ratings as well, right? We have that's one of the benefits of the AI, Dan, right? We
Hmm.
build all these models on all these individual companies, and we can aggregate them into a model for an ETF or a model for a mutual fund or a model for a sector. And so our
Hmm.
sector models are flashing a really strong green on energy. And then technology is one we like as well, even though the sector rating is still neutral, right? And we brought that one up in the webinar because it's important to understand that you can't paint any one group of stocks with the same brush, even if they're in the same sector,
Right.
right? Even though the overall energy sector looks attractive, I don't recommend all energy stocks. Even though the overall technology sector looks neutral, we don't hate all technology stocks. In fact, most of that neutral rating is a function of, you guessed it, 6 or 7 stocks being really expensive, right? So,
Right.
but we think there's a lot of opportunity in the tech sector and in the energy sector. And we've been writing on a lot of energy names for a long time,
Mm.
and they've done really well for us. Anything from master limited partnerships to some of the big oil and gas producers like BP, um, is one.
Mhm. Yeah.
The least attractive sectors are real estate and utilities. Utilities kind of obvious, right? In a rising rate environment, you've got no real cash flow growth. It's just, uh, and real estate's been really overvalued for a long time. Um, we've been spending a lot of time giving away some of our, we call danger zone picks and zombie stock picks, because we just feel like investors just deserve. Like I feel like almost it's like my public duty to help people just avoid some of these complete junk stocks that are circulating out there.
Hmm.
My most recent e-letter, I pointed out a company, Root, ticker ROOT. The Wells Fargo analyst on April 11th raised her target price from $5 to $60 or something like that. I don't remember the exact number, but it was like a huge, without changing the rating. And
Okay.
the stock went. I'm going to look it up here. The stock went from from about $10 up to 80. And then around 65, she raised her target price, and it's now down. In the last week, the last month, or the last week or so, it's down 10-20% since that time. And to me, that was just an obvious pump and dump scheme,
Hmm.
right? We pumped it up to a big number, and we want to give our institutional clients some time to get out. Let's sucker some more retail folks in and let them sell. I think
Wow. That is, I think that might be the most aggressive upgrade I have ever heard of in my life. a 12-fold increase in price target in one go. I mean, wow. I mean,
Yeah.
if I were, if I, like, I don't know, I could say things about the SEC, but if I were there and I saw that, I would stop doing whatever else I was doing and take a closer look at that. Just reflexively, just knee jerk.
Yeah.
It's,
I 100% agree. Yeah. And, not surprisingly, the options activity was skyrocketing around the same time.
mm,
And, the funny thing, you bring up the SEC, Dan, there's a lot of things that have been going on. That when I was on Wall Street, right, in the late 90s, early 2000s, I mean, people were getting away with doing things that would have gotten them perp walked. I mean, all these forward-looking statements that don't come true.
mm-hmm,
I mean, that would have gotten you. I mean, the FBI would have been at that manager's door and parading them in handcuffs to the to
yeah,
the thing with movie cameras. If they say stuff like that. So there's all kind. I mean, I think the SEC is hamstrung in a big way. I think they're afraid that if they call out some of this BS and the stock creators, they get sued.
right,
Part of that's because so many of these companies' valuations have become so disconnected from fundamentals that people are like, fundamentals don't matter anymore. There was a time when the SEC could do
yeah,
this, stock would get cratered, and they'd say, well, now it's more appropriate to the fundamentals. Well, that argument doesn't hold water because the markets have been so disconnected from fundamentals for so many stocks for so long. We don't really have any
right,
way to find sure footing anymore.
right. Yeah, that yardstick definitely was broken by zero rates for, the better part of um, what, 14, 15 years, something like that. From December 2008 to March 2022, most of the time, um, spending at zero rates kind of screwed everybody up. I think it just sort of pulled the rug out from under. There's no benchmark anymore. So, but we're back to like 5% on T-bills. So I feel like even though the effect may not be immediate, and there's still plenty of like mega bubble valuations out there right now. Um, I mean, this sort of gives us a better footing than 0% T bills, or 0.25 or whatever they were, doesn't it?
Yeah, 100%. When money is cheap, right,
Hmm.
or effectively free,
Yeah.
of course you're going to move out on the risk curve because you're
Yep.
not. There's no what's your downside,
Hmm.
right? That's why we saw all these zombie stocks born during that time because it's like, oh well, I'm running out of money. I just go get more. And what we lose, Dan, that I think is so important to society at every level is discernment. If we're
Mm.
not discerning about where we allocate our resources,
Yep.
society is ruined. And when
Yep.
you got free money and people aren't discerning about where they allocate their capital, right? Society eventually is ruined because if we become a society that keeps throwing good dollars after bad, where does all that go? It goes to all the bankers and CEOs that are robbing from you instead of the
Right.
companies that are growing and creating real value. The United States is founded, I believe, on our success is founded on intelligent capital allocation, discerning capital allocation.
Right. Yeah, and ultimately it leads to this sort of you know divided society where the upper 1% or whatever percent you like is seen more and more and more as a kind of exploitative criminal class rather than the most productive people. And there's still many, many productive people, but if it keeps going a certain way, like for example, guys like Jamie Dimon effectively have their $1 billion fortunes backstopped by the Federal Reserve, right? Because they're too big to fail. And eventually, I think you're right. That does wear on people. And, you begin to see like protests and violence in the streets. And it takes a very long time, the way things go in societies over time to sort of make the connection. But I agree. It could be returned to a normal state if we just have more reasonable benchmarks. And I'm hoping that higher for longer interest rates will help us do that, but we'll see. So it's been great talking with you here. It is time for my final question. And it's the same question for every single guest, no matter what the topic. Like, even if it's a non-financial topic, sometimes we have non-financial guests, exact same question. And we can edit. So, if you just want to take your time and think about the answer, that's fine too. But the question is simply this, David: if you could leave our listeners with a single thought today, what would it be? What would you like it to be?
If I would leave your listeners with one single thought, it would be to be more discerning. To be discerning in terms of what you put into your body, what you allow into your brain, what you watch on TV, and of course, how you allocate your capital. Intelligent
Mm,
decision making takes time. It takes gathering of research. It takes gathering of information. And I want to help people be more discerning. I want to improve the integrity of the capital markets. And we do that by giving people data that allows them to make more intelligent decisions. And it's there for the taking. But people got to want to do it. And I think what we are missing these days, Dan, is that they're too often tempted by zero rates, free money to gamble, go with FOMO, go with MOMO, believe that it's getting you can get rich fast and easy, which is just not
yeah,
true.
right. I agree. The zero rates are gone, but the habit's still there. Yeah. That's a great answer. Thank you. That's a really good answer. It's funny. We used to get all financially oriented answers, but now we're getting more of them that are either completely just sort of philosophical in nature and only apply tangentially to finance. But we're getting more like what you did, which is, it's about life as well as finance. It's sort of an all-encompassing answer that investors can apply and that they can apply to their life. So thanks for that. And thanks for being here, man. It was really good to talk with you.
This is great, Dan. Thanks for having me on. I love talking about this stuff. And I love that you've read Expectations Investing. That is awesome. Major hat
Yeah.
tip. That is, I mean, once you've read that, you can never go back. It's like
No, you
it's so
can't.
logical.
Yeah. Once you read that, you're like, oh, I've always known I couldn't predict the future, but now I know what to do about it. you know? So yeah. Yeah, you bet. I recommend that book to everybody. I've recommended it on the show more than once. Absolutely.
There's a
But
short report that you'd love. It was written in 1996.
oh,
It's called the neglected value driver. It's like 10 pages. It's
okay.
Mobison's. It's like the precursor for expectations investing. It's
Oh,
like
okay.
if you have people who don't want to read a whole book, and I can send it to you if you want, Dan.
Oh,
But
okay. Yeah, that'd be great.
Mobison wrote it shortly after I got to Wall Street, and
Hmm.
I remember I read it and I took copies and I handed it out to every single analyst on the floor. And they're like, "What are you doing, trainer? Are you some kind of kiss ass for your boss or whatever?" I'm like, "No, you read this and you'll be changed forever. It makes so much sense, but you'll love it
Right.
because it's like 12 pages and it's expectations investing in 1996 as opposed to when was expectations investing published? Like 25 years later."
Um, yeah, I wanted to say 2012, but I don't think that's right. I
It's a
forget the
cool
date.
paper. You'll like it. And
Yeah.
if you got people who don't want to read a whole book, you can say, well, just read this little paper and it'll get them to the same place.
Great. I'd love to see it. Yeah. All right. Um, Again, thanks a lot, man. It was really good talking to you.
Thank you. I enjoyed it. Thank you, Dan.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.